Good to have you with us. With the U.S. President Donald Trump's Twitter saying with the great vote on cutting taxes, this could be a big day for the stock market and you. So as the tax bill is finalized, is it in your expectation? And what and who should be concerned right now? And how will this affect the market by the year end?
Well, it's not a matter of who should be concerned, it's a matter of who's going to benefit. So there's no real concern coming out of the initial stages of this tax bill. It is true that the vast majority of Americans and the vast majority of corporations will get a short-term break here, but that'll get taken away in the coming years. So it's not about being concerned at this point. It's about who's going to benefit in the short term. And right now that's corporations, pass-through corporations. So it's materials, industrials, financials because of higher long-term interest rates based off of potential growth. I think this tax plan is going to add some to GDP in short term, but it's taking GDP from 2020 and 2021.
For commodity market, today oil dropped below 58 per barrel as investors waved on increase in U.S. drilling rigs against OPEC's promise to extend output cuts through the end of next year. So what's your outlook on oil market in the short term? What could be the resistance level?
4 of 6 weeks now higher in rig counts in the U.S. It's safe to say, in my opinion, by the way, one of those that was not up was flat. So it's safe to say, in my opinion now, that rig counts have kind of flattened and are possibly turning back up. Production continues to increase. The most important thing in crude oil is the curve is now in backwardation, which is the normal shape of the crude oil yield curve. That means U.S. producers can sell at a high price now and hedge out future production, and they can continue to pump. The narrative has changed in crude oil from the OPEC meeting and the production cut extensions which happened to how much production is this price going to generate from the U.S. It's going to generate a lot. I think we'll see a spike above 60, but that'll be about it. We'll sell off from there.
Gold remained in a tight range for much of November. Will it stay at the same tight range in December by the year end?
I think the only option for gold is this range or lower. I've said this before. Other than geopolitics, which is not dismissed at this point, other than a geopolitical event, gold is not going to return anywhere near what it did in 2016, certainly not what it did in 2015, in 2018, barring some sort of geopolitical event that causes gold to spike. Gold is not an asset that's favorable in my view right now.
Volatility or not, Bitcoin has become an institutionalized vehicle of investment for investors. So with the CME and Nasdaq both rolling out financial instruments to manage risk associated with Bitcoin, it is likely that volatility associated with it will be tempered. Additionally, as a result of the rollout of futures and the hike on Bitcoin, investors and traders alike will now find ways of managing portfolio risk more commensurate with other instruments like gold. So from your point of view, what may concern you most on trading Bitcoin right now, and what's your prediction on the trend of Bitcoin?
I think what concerns me the most is that short-term traders will go into the futures contract to speculate, rather than taking that knowledge out to the Bitcoin traders and showing them how to hedge. That's really what should be the concern. The futures markets that are being announced should be used to hedge the meteoric rise. My main concern is that Bitcoin becomes like pet.com or extreme telecommunications in the 90s, or Webvan, which was another one where they do these meteoric rises and it's unsustainable. You need to use the futures contracts to hedge if you're in Bitcoin. That's my most concern, that people use that as a leverage tool as opposed to a hedging tool.